retailers in developed markets have shown stunted growth as their economies struggle and consumer confidence remains shaky. For international companies, South Africa offers a springboard for expansion into the fast-growing African continent. For more, we're joined in studio by Sid Vianello, equity analyst at Nedcore Securities. Sid, it's always a pleasure chatting to you, and I'm sure you've been occupied by Shoprite's results. Headline earnings per share up close to 20%. The share price standing strong, much to Wayne's amazement. He was telling me earlier today, because everyone expects Shoprite to do well. It's in the price.
There are no surprises in the numbers, but you must bear in mind that 20-odd%, a lot of that is due to the tax issue with the SDC disappearing. A more appropriate number would be to look at a trading number, where on around about 14.5% turnover growth, you got just over 15% in operating profit. So the operating margin, in fact, was pretty much, it wasn't static, it was very, very, very marginally up in last year. And that perhaps gives you some clues as to how tight trading conditions really are out there, and how competitive the market is out there. I mean, they gave you another figure. If you take market share, and these are numbers presumably that come from Nielsen's, a year ago, if we compare July 2011 with June 2012, market share in fact has gone up 1%. That's a fantastic number, but all of that in fact happened in the first half. I then pointed out to them that market share in December was 34.0 and in June it was 34.1. So in fact the market share in the last 6 months, which is probably it's gone nowhere, which is indicative of how tougher in fact it's become as trading conditions have become tighter. You know, you've got another competitor out there in Cape Town who's fighting like mad to win back the market share which they've lost over the years. And of course you've got Massmart coming out tomorrow, and we'll hear, you know, how well or badly Cambridge Foods perform. But I mean, it's a very, very, very tough market out there.
Now, Sid, I must say I'm very happy you're here, because we need seasoned campaigners to cast light. I mean, we're talking about Shoprite, 16% trading growth. How can the share price go up 2%, 2.5% today when it's already at a 25, 26 PEs? We know the foreigners are buying. Don't they care about valuation? Is it just a theme that they're buying? Locals aren't buying it at this price. In fact, locals are all underweight.
Well, I'm going to answer it, and then I'm going to give you another observation which came from the presentation today. The answer is that on Friday, Shoprite's share price fell, from the way in the mid 160s, closer to 170, it fell all the way back to 157. It fell by over nearly 6%. All it's done back, it did yesterday and today, it's actually clawed back a little bit of it. So 160 is in fact still way off the peak. But when you look at the numbers of 6 rands a share fully diluted or thereabouts, and you compare 160 rands, and you say to yourself, you know, we're now on a historic PE of 26 or something, you know, investors are certainly pricing in one hell of an expectation, to put it bluntly, to put it very mildly. The second observation, interesting, Whitey Basson, and I think you're seeing him later on today, ask him about a slide he put up about the market caps converted back into rands of many of, he left out the world's biggest retailer, he left out Walmart, but he put in market caps of virtually all the major European food retailers. Do you want to know something? Shoprite's market cap is bigger than that of many of its major German and French competitors right now. Believe it or not, that is the extent to which people are prepared to back the Shoprite story, and presumably the African expansion that they anticipate.
But the big question is, how far can this backing go? How much higher are our retailers going to go? I mean, so surely this is defying the odds.
Well, the logic is they should not go any higher. But I'm going to tell you a little story. Many, many years ago, we're going back 15 odd years, I used to say when Rembrandt's market share in cigarettes was 86, and I said, can it go any higher? Well, then it went to 87. And then you ask the same question. My word, it went up incrementally 1% a year until it got to in the early 90s. And then, of course, came the big merger when, you know, the whole thing became irrelevant in any event. So how much higher can these share prices go? I'm scared to turn around and say that we are now at a peak, because you saw Mr. Price today.
Every time anybody calls it, they push through.
They just go higher.
To make new highs.
They just go higher. But, you know, the stark reality is that trading conditions are tough. I don't know if you saw the Edcon, you know, the PDY Limited, the unlisted Edcon came out with numbers there. You know what the turnover growth was for the quarter to June? Less than 2%. Less than 2% on a year ago.
We saw Truworths as well. I mean, they hardly grew if you take out inflation.
No, you strip out inflation, the units were down. Yeah. Edcon's volumes were down as well. But that shows you how tough it is out there.
Come on, Wayne.
It does defy
is the story over? Be brave enough to say the story is over on the retailers.
It doesn't worry me being wrong. I've been wrong plenty of times. Look, I suppose at the end of the day, you're torn between two things. Number one, every person and their dog, whoever you talk to, will say they're value investors. They'll all say they're value investors. We are long-term value investors. And if you hang your hat on valuations, these shares are seriously expensive on a valuation basis. But then the other side is they keep going up and have done so for, what, 4 years?
So you sell at your peril.
That's the
That's
problem.
what it boils down. I mean, I'll disclose. I own some Shoprites, which I paid 16 rands for. And that was only about 5 years ago. Now they're 160. And I was thinking...
You're still holding on?
I still hold them. At about 100, I thought maybe I should sell. Well, in retrospect, thank heavens I didn't sell, because look where they are now. You sell at your peril.
But you must hang your hat on valuations, because sometimes, you know, the bell doesn't ring when it's time to sell.
Sure.
And sometimes these things can bite you.
How deep can the reversal be?
Well, you saw on Friday. I mean, it didn't take long for the share to drop 6%. Took one afternoon, am I right?
Yeah.
And the share dropped 6%.
But 6% you can handle. We're talking about a calamity here.
Well,
is there a chance?
What happened in 2008?
Is there a chance that we could see 50% off current valuations just wiped off the board?
I'll tell you the one trigger. I think there's one, right now, there's probably one potential event that can cause it to happen. A major downgrade of South Africa's sovereign rating. Something like that. An event like that, I think, could see... Look, you know, these big high flyers come down to what we would call reality, but then of course we're not entirely sure what the definition of reality is anymore.
I mean, when you look at these big trends, if you take the resources and before that the financial shares, normally these things unwind slowly. They almost sneak up on you. I mean, if you take the big resources run, I mean, it lasted 8 years, and the shares just carried on going up, and then they got clobbered. Now they've gone down for 5 years, and the retailers. So I think it's unlikely that these shares are going to collapse 50%. But in relative performance, I mean, it's so simple, and we've spoken about it so many times. Billiton's a 7 PE, Sasol's a 7 PE, Anglo's is a 7 PE, Shoprite, Spar, Woolies, these are all 25 PEs. This trend will reverse. But I don't think it's going to be sudden. Personally, I just think it's going to be underperformance by the one and outperformance by the other. But of course, if you don't call it, you suffer.
But Wayne, isn't that exactly what happened post 1998?
Yes.
I remember, and I'm thinking back, remember looking at shares, Imperial, Bidvest, and I think Barlow's could have been the third one. The share, in fact, the earnings grew every single year for 6 years in a row. But you want to know something? The share price did nothing for 6 years in a row. So what happened? The PE just came down. The PE just came down, all the way down, back to, call it the starting point. Reverted back to the mean, so to speak. I don't know. We could well be in for that, but when that's going to happen, right now...
But responsible investing...
should be valuation based.
Exactly.
But your clients leave you if you underperform.
Well, you've got to have the answers. I don't have the answers. How can you get your clients to do... I mean, the bottom line is that you should make a call on valuation. But
no, you have to make
But as you say, perhaps our sense of reality is completely different now.
Yes, I know. And the great fear is, and we go back to that same 98 period when Abby Joseph Cohen, the great strategist from Goldman Sachs, said, and I still remember the quote, "The time has come to change valuation methodologies. We must now value IT companies as a multiple of turnover." Yes. My word, famous last words, and look what happened.
Exactly.
Remember that, Wayne?
Remember that.
Listen, I can remember a couple of things. In 10 years ago, we were worried that there wouldn't be any US long bonds in the system because the government was running such a surplus.
Correct.
And they were buying back their own bonds. We were worried about how you could hedge long-term liabilities. And remember the death of inflation? So there's all of these things go. But at the time, when you live in it, it seems very real.
But we're starting to have these conversations. Those should be red flags. When we start talking about changing the valuation models to incorporate...
Look, maybe we're not quite there yet. I mean, 25 PE is steep, but it's not 50, you know, like the IT thing. So maybe, look, I don't think there's a collapse, and I think it's highly unlikely until interest rates go up. I don't know what Sid thinks about that.
All right, well, let's look at another one. You wouldn't deploy new capital, would you? Or would you right now?
No, I'm not going to put new capital in it. But my gut feel tells me that I sell at my peril. So I'm not going to sell what I've got, and presumably that's what that's the dilemma facing the South African fund manager now. The only difference in their situation, the fund manager's situation, right now, I don't have any.
Yeah, but we were sitting with Glenn Silverman, was it last week or the week before? I can't remember.
Solutions.
Yeah, and he was saying that only 17% of the fund managers in South Africa have outperformed the index. Because you all know what the index has done. Resources have gone down, and retail and banks have gone up. So obviously, SA guys are already overweight resources and underweight retail. So you sit and you wait.
But if you look at the shareholder registers,
it's all overseas in the retailers.
That just enhances his argument. Shoprite is probably 60% foreign. Truworths is virtually 70. Clicks is 63 at the latest count.
To that point, talking about a potential calamitous situation, foreign capital is traditionally flighty when it comes to South Africa. That's a huge risk you're exposed to.
That is, why do you think some of those shares, my view, is those shares, why they dropped as much as they did last week? Foreigners took fright. And you know, when a foreigner says sell, it doesn't mean sell 10% of my holdings, it means sell 100%, and I want out by the end of today. Period.
We're out of time. Your top pick in the food retail sector?
Right now, if I have to pick anything, I'd probably go for Spar.